Welcome to the OPEX Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kachuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital.
So, Brent, I feel like I always start these out the same way. It's always like the market keeps rallying, it's not stopping, and I'm doing it different here. It seems like basically, again, the market keeps rallying and it's not stopping.
This is a very true statement, Jack. And the reason I'm pausing is because just this past weekend was these unfortunate events that took place at the Trump rally, and as stock market commentators, we always just sort of jump through the sort of humanitarian aspects of these things, be it war and other things. But the reason I bring this up is because Trump's odds have surged, and that seems to have also put another fresh bid into the stock market here. As we sit here, small caps are ripping, and S&P is back to moving to highs, and it's a train that doesn't stop.
Yeah, it's always been weird for me to do this because there is so much stuff that goes on. Obviously, this is a very tragic event. Like, these things go on, and it's hard to talk about the stock market, when you see those things happen, but that is our role. I mean, there's obviously people who are much more intelligent to analyze those things than me and you. And our job is to look at the implications of it. And you're right. And particularly also in response to that inflation print, like that was a very weird, and maybe we'll get into this later, but like that day after the inflation print was a crazy day in terms of the divergence between small caps and the rest of the market. I mean, it was like, historic in some ways in terms of how big that divergence was.
In terms of options data and flow, it was historic. We are going to cover this a little bit later in the presentation. And this all ties into the weird things happening in correlation. And I would say up until Thursday of last week in that CPI print, and I'm still very cautious on this market. But in the very short term, we have the inflation coming down, and I think people are, I don't know if there's a Trump bid to the market, but that seems to be what's going on today. And so that adds an extra dynamic. There's a lot of charts. I feel like I had to come into this presentation and update this morning because of everything that's just happened over the weekend. But we're going to get into it here and just break down what we're seeing. And the reason I call this correlation spasms is because, Jack, we had a conversation in April where we laid out this idea of volatility suppression and record low equity correlation. I call it intercorrelation, where inside of the indices themselves is very bizarre movements. There's all sorts of record movements happening everywhere, where it's lowest vol ever, record call volume in the IWMs, and all these bizarre things taking place. And I'm calling it correlation spasms. And this actually ties into what you talked about, how on Thursday or on Wednesday last week, there was that wacky move up for no apparent reason. Then we got the wild move on the CPI where we were just ripping all over the place up and down. So these spasms are starting to translate into volatility a little bit. And we're gonna break that down along with our normal OPEX stuff here. So enough of my yammering. Move forward here.
Yeah, let's start where we always start. We always start by talking about the OPEX cycle and why it's important and how it works.
Right. So the general idea here is that typically it's every month, right? The third Friday of every month is the biggest options expiration, kind of local expiration. Yes, there's expirations every week, but it's the third Fridays that tend to be the biggest. And what happens is, after that third Friday, all the options positions expire, and then over the ensuing 4-week period, options positions rebuild, hedges associated with those positions rebuild, and the impact of the options market, in my view, sort of hits its apex right at options expiration, which is this week, and then we kind of reset following options expirations, positions reset, stocks shift accordingly, and then the cycle continues. Now, there's also a quarterly cycle to this where we just came off of a massive June expiration. We're going to touch on some of the impacts of that a little bit. But as we move forward into this June expiration, what we'll find is that there's a couple of stocks that have a very, call-heavy tilt to them. We're looking for a little pause in the equity market, a little bit of a shift or contraction before what seems to be just sort of another leg higher coming up. On this chart here, the red X's are options expirations. Not every single options expiration matters, but some of them are significant turning points. You can see just recently we had major lows earlier this year in March and June. The market bounced there. The last two options expirations, which was June, there was some consolidation there, and then we legged higher. We saw the similar thing the month before that in May. So There are these major inflection points. We always point to March of 2022 or December of 2019 as the most obvious kind of historical points. In this July OPEX it's a little bit of a smaller one, as you could see on this chart here. The orange is call deltas is how we measure this. So, very, very big call deltas relative to put deltas. But in the realm of things, this options expiration is about a half to maybe even a third the size of June. We always talk about this key zone here, 5640 roughly to 5700 is what we're looking at for this week, is where those biggest positions line up. You can see over 5700, the positions really wane, meaning that the call positions are smaller, which is not unusual. But we like to see those positions build up at overhead strikes, and that tends to be a signal to us that the S&P is ready to sort of move forward. You can think of this box that I've drawn on here, this yellow box, as sort of the big at-the-money positions, and as that box slides up and down, that helps us to sort of estimate or forecast where the stock market itself is going to move.
So in general, the idea is this doesn't seem like a huge expiration. I assume we probably do have, if we look out to the future, we probably do have a bigger one coming when the quarterly comes. Like, are you seeing that as we look into the future?
Yeah, when you look at the chart here, this is expiration breakdown. September is the big one that we're facing. It has not double the size of July currently, but it's certainly at least 30% bigger. And you have to remember that the options positions will build. So, right now we're already bigger, and we're 2-3 months out from that September timeframe. So these positions will really start to increase as we get into the summer. And that's right before the election, which is also kind of this other, interesting little dynamic in there. And then you can see December is obviously always a monstrous expiration as well. So, July and August are probably, relatively smaller options expirations, relative to these big September, December expirations.
Yeah, it's interesting. We've had a few different people in excess returns, and a lot of people have been talking about kind of the same scenario, which is they're expecting sort of a pullback in the market, maybe into the election, and then like a huge rally on the backside coming. I don't know if you're seeing anything that's similar to that in what you look at, but they're expecting like a big fourth quarter rally. And I don't know if that gets into maybe what we've talked about a lot before on this podcast, which is this idea that as we get into the election, people are going to start hedging, and then as we get past it, it probably won't be as bad as people think it's going to be, and then maybe you rally on the backside of that.
Yeah, I think heading into last week, I was feeling like we were going to cruise a bit for the summer. And I think still ultimately that's going to be the case. I think, Trump right now is 70% odds. And so I think the market could start to adjust, or will start to adjust to the odds that he wins. And I'm not a political commentator, so I don't know if that's accurate or not, but the betting market's over 70% in favor of him now. And that could always switch, obviously, over the coming days and weeks. But the point is that I think the market likes certainty. So maybe the stock market, I think from the stock market's perspective, neither of these candidates are particularly bearish candidates. I mean, the market's at all-time high with Biden. It was at all-time highs with Trump. And so, I think if we had like an actual socialist a la Bernie Sanders coming into the market, and we didn't know how to choose between like a Biden and, Bernie Sanders, Trump and Bernie Sanders, then there would be a lot more angst around this. But generally speaking, I think the market hasn't been too fearful of this election. However, if we could start to pull forward an expectation of who's going to be president and, what policies are that we can invest around, I understand there's a little bit of uncertainty of whether Trump is inflationary or not. He's very pro stock market. I mean, we can remember what he used to, his rhetoric from the days of when he was when he was president, saying, all-time highs and stuff. So anyways, the point is that I think there's nothing in the short term that says the trend higher should break. However, we can have mean reversion around the trend. And this ties back into some of the correlation things that we're bringing up.
It's interesting to think about it, because in a lot of ways, like the fact that people are hedging coming into an election requires uncertainty, right? So if it becomes very clear that someone else is going to win, then some of these dynamics with hedging into election that we've seen in previous elections probably don't play out here. If it becomes very clear one candidate's going to win over the other.
Yeah, and that's really it. I think the market doesn't like uncertainty. It doesn't like, I remember around the Trump election, some were saying, well, we're going to hedge around the fact that he may not leave office. And there were some kind of, stranger scenarios that people were looking to hedge. And look, if you want to hedge that extreme tail risk of stuff, then that kind of makes sense. But I think a Trump victory, once that starts to get priced in, I don't think anyone's thinking that Biden wouldn't leave the office. So I don't know. I just know that the market does like certainty, and that means less hedging. So to the point about the market rallying after, I think there's a little path dependency maybe in there. I don't know. Sometimes I think there's this idea that monetary and fiscal policies are a little more favorable when the incumbent is running. And so, maybe there's roosters that don't come home to roost until after an election. So I don't know that's in the bag that we extend, this rally into 2025. But if inflation comes down and the Fed does get this incredible soft landing, and earnings continue to be good, particularly in those semi names. I mean, Taiwan Semi put out some really good numbers last week, and that pumped NVIDIA a little bit. So, regardless of who's president, AI and the semi chip sector can save us all from certain doom. So that's always a good, backup plan.
Yeah, what's interesting about this chart you have up right now is like we keep working more and more right, and they're keeping less and less dots. We're getting into like a little bit of uncharted territory here as we keep moving right.
Excellent observation. So about a week or two ago, you could read Goldman put out largest ever positive gamma in the market. That's in the S&P 500. And why that matters is because when you hedge and you're a market maker and you have extreme amounts of positive gamma, that means that you have to sell a lot of stock when the market goes up, and you have to buy a lot of stock when the market goes down. And obviously, if you're a huge player, that can keep the market from moving too much. It puts guardrails on the market. When you put those guardrails on, that suppresses volatility, right? There's not a lot of room for the market to move. And so what you can see is that as we move right on this chart into this kind of record territory, there's not too many dots on this area in this chart. And this chart's 5 years old. So, there's only a few points where we've been in this index. We call this our gamma index. And volatility, just doesn't move all that much. And so that's the environment we're in. We're going to lose about a third of gamma now, starting kind of Wednesday, which is VIX expiration, into Friday. And so that loss of about a third of our total gamma should drop us to the left on this chart. As you can see, volatility expands, not massively, but volatility should pick up now with this options expiration. And generally in these scenarios, we look for that volatility expressed to the downside a little bit. So, 2-3% pullback, something like that is generally what we look for during periods like this where we have a lot of, record positive gamma expiring.
This next chart is a cool study we talked about for the first time in the last edition here. This idea that, we'd always talked about options expirations as turning points, but you actually looked at the data and looked at how often they're turning point.
Yeah, so we went back over the last 5 years of data and looked at whether VIX expiration occurs before OPEX like it does this week versus after. And what you can see, there is a difference in return. So what this simply said is if the market rallies to options expiration, what typically is the performance after? And it actually, interestingly, matters whether VIX expiration occurs before or after OPEX, equity OPEX. So what you see here is about 2/3 of the time, 68% of the time, when VIX expiration is before options expiration, the likelihood of a performance flip is 68%. So that simply means we've been rallying this week. We have VIX expiration Wednesday, Friday's options expiration. You got a 2 out of 3 odds that the market is lower next week than it is this week. So, we're opening here at 56. I haven't checked the market recently, but we're 5650-ish in the S&P 500. So, okay, we pull back to 5550 or 5600. That's still an incredible number. And then we likely kind of bounce from that general area. As you can see, it really does shift, right? The returns before and after options expiration. It's really quite interesting and points to the impact of the event itself.
So we're going to take a look back. We always like to take a look back at what we said in the previous episode to see if any sense came out of our mouths. What are you finding when you look back at what we talked about last time?
Yeah, there was a couple of things, and I'm short on this because these themes are going to pop back up. So the big part of our presentation was talking about this record correlation and the fact that suggests that volatility should come down, meaning realized volatility or how much the market's been moving. Turns out at the start of last week, we had the lowest realized or historical volatility in the S&P 500 that we've had since 2017, I believe it is. So, you're talking about, again, these record periods that are coming up. Realized vol in the S&P was sub 6 on a 1-month basis, which is rarefied air, certainly post-COVID records. And so, that tells us the market's not moving a whole lot. Now, on Wednesday, this past week, we actually had our first sort of little bout of volatility where the market rallied up about 1%. I'm going to cover that in a minute. So that correlation signaling low volatility seemed to come true. Another thing we talked about was how large the NVIDIA call complex was, and we were flagging that the outperformance of NVIDIA should kind of start to come to an end, and we were looking for a pullback in NVIDIA. We got a pretty nasty pullback, actually, the day of options expiration. We'll chart that in a second. In the performance of NVIDIA Sense is pretty interesting. And then lastly, we were talking about the struggle in small caps and the fact that there wasn't really a lot of gas for these things to move and how much it mattered if you were along the Qs or the S&P, how much you were outperforming. It was excellent. Well, come Thursday, this chart doesn't look so good anymore. Suddenly small caps have surged quite a bit, and we're going to dig into that in a minute. So, looking back, those were the themes. I think these themes are they're going to change a little bit. Does that mean some short-term volatility in markets? But I think overall, these themes changing is actually a signal of a healthier bull market, and that's what I'm looking for over the summer. But this idea of record low correlation and low volatility, I don't think this necessarily has to end with a bang in the current setup here. But again, the idea of correlation spasms is something that I really want to put forward here.
Yeah, in terms of the idea of the healthier market, I mean, this is something everybody's been talking about, which is this idea like this has to broaden out. And I'm sure we'll talk about this later, but like for the rally to be like a little healthier, like you don't want it driven by 3 stocks or something consistently.
Yeah, 100%. And what's so interesting about this is, in like you mentioned, we're going to talk about this, is I think people understand from a breadth perspective why that's not healthy. But there's actually a trading, we call it positional impact of that correlation, and the lack of breadth, right? To the point on record realized low volatility, you could see here, this is where we were, again, sub 6. We've lifted a little bit in the last couple of days. But you're talking about the record period of 2017. In October of 2017, we hit record realized low volatility of 3.5. With Trump surging the election, I've been trying to think this morning, is that a number we may attack now? Because CPI is coming low and Trump being very pro stocks. I don't know how to put forward all this, as I'm not a macro specialist or a political analyst. The key here is that this doesn't happen in a straight line, right? So you get a little jump in vol, and then when that vol pops, people go, great, I can sell it, and then they'll generally push that to a new lower bound, right? So I think very short term, little pop in vol we're looking for, but you have to start to look at some of these other 2017 effects as we especially head into the election, right? And consider that September, October timeframe of possibly being a high in the market, or at least a low in volatility. It's kind of an interesting idea.
Is there like a coiled spring aspect to this? So in other words, the longer we get this lower volatility, the higher the chance it's going to end badly. I know you were referencing 2017, which eventually did after it dragged on for a lot longer than people thought it would.
2017 was obviously so fascinating because you had the short vol ETPs. And that was the obvious imbalance, right? There was a big positional imbalance, right, that had to get unwound when we got a little bit of a vol event in January of 2018. So this big position built up. I think the argument now is that, well, hey, Brent, point to the big imbalance in the market, right? There's not this XIV product or this margin call that has to happen or whatever it may be. And my point is that, in a way, this record low correlation is kind of the imbalance. It is the risk. And what's interesting about that January 2018 period is it was this vol shock for about a week, maybe 2 weeks, right? And then if you look forward a month, the S&P was higher, and it was like, okay, great, the positional imbalance is cleared up, and we all moved along with our lives. Options people still talk about it, but people like yourself, the value guys, is like, something happened. I didn't even know. So you can't. What's also interesting about vol is there's a lower bound, right? So if you look at a 3.5 realized volatility, there's the rules. It's called the rule of 16. You can divide that 3.5 by 16, and that tells you what the average daily move was roughly. So you're talking about 25, 30 bips of daily movement in the S&P. That's nothing, right? It's easy to break 25 bips in a market rally just as it is if the market declines. And so what happens is, if you are actually trading implied volatility or selling implied volatility or selling the VIX based on basically the lower bound of volatility, vol can't go to zero, right? You have no room for error. So as soon as you get a little move in volatility, then suddenly the people who are short vol at an implied vol, let's say 5 or 6, they suddenly go uh-oh, and they have to cover, right? And they have to adjust their positions, and that itself causes a short-term volatility shock. So you can see that if you ever draw trend lines on volatility charts, the options geeks will come out and start, yelling at you about it. You can't do TA on trading analysis on volatility charts, right? But there are these wedge patterns that form all the time. And I think it's like this echo effect that happens where, right now, all of us would love to sell 12, 15% implied volatility. So as soon as vol pops a little bit, you come out and sell it, right? And then, you get that echo response. And that's kind of what happened in XIV in Volmageddon back in 2017 is everyone was shorting 3.5% realized vol or like short vol at that level. And so as soon as we got just a little bit of extra vol, right, like 8% vol, everyone's like, great, let's sell that because vol always goes down. And so once that vol popped up for an inflationary reason or whatever else it was, people had to cover from these very, very low levels of volatility, right? So the point being that a lot of this is all relative, but there is a lower bound in vol, right? And you can sort of lean on that forward expectation of saying, I can't be short this anymore because even if the market jumps 1%, I'm going to have to cover, right? I'm going to be in trouble. And that can cause some spasms, some short-term volatility spasms.
So in this next one, you talk about the fact that NVIDIA has been stalled in here.
Indeed. So in June OPEX is where we called, we came out, we showed all this data. NVIDIA had the biggest call complex in the U.S. equity space. Very unusual for NVIDIA or a single stock to have a bigger call position in the market than like spiders.
Has that calmed down now?
Yes, indeed, definitely. Yeah.
Okay.
So we lost a tremendous amount of NVIDIA call positions at options expiration. And what's so interesting, you can see we peaked the Thursday before options expiration, and then we dropped very, very sharply. As you can see, it was a 15 to 20% drop from the Thursday before options expiration to the Monday, Tuesday after. And then we, by and large, just sort of stabilized and trended sideways. NVIDIA did get a little pop recently due to the Taiwan semi earnings. They said that their revenues are very good and they supply a lot of stuff to NVIDIA and Apple, and so those two stocks caught a little bit of a bid. And our view is simply saying, look, and I'm going to get in this in a minute, so I don't want to cover it too much at this particular juncture. Is this stock has been outperforming the broader market at an unbelievable pace. And that's one thing for a mid cap or small cap name maybe to outperform the market at such a pace. But you're talking about the third largest stock in the world, right? Very unusual for that outperformance to continue. And we had sort of felt like, okay, this outperformance is, let's stick a fork in the relative outperformance, and I'll talk about that again in a minute. And then the last thing that we covered was how sleepy the small caps were, and there just wasn't a great catalyst. And so you could see here that the Qs were really, holding outperformance. It wasn't blistering outperformance over the last month, which is what this chart shows. But then on Thursday with the the cool CPI, I keep saying hot CPI, the cool CPI, small caps really jumped, and they closed this performance gap in an instant. And we're going to dig into some of that data too here in a minute. So that's the recap. I think by and large, the OPEX views were pretty accurate. So kudos to you and me.
Mostly to you, because I didn't provide any insight, but still. So yeah, so as we switch to what has moved now, or where we're going forward, like you've got this idea of uncorrelation.
Yes, and so what was so interesting last week is all of a sudden on Thursday, it's like, bam, record IWM call volume. That's in blue here on this chart. I'm sorry to it's not the most viewable, but this goes back to 2020. I wanted a really long-term time frame to nail this home. Biggest call volume by far ever on Thursday. Puts are here in red. There's a decent little pop in put volume, but huge call volume in the IWMs last week. And if you look at, sorry about that. If you look at the IWM open interest, even though we had 3.9 million calls, which is an unbelievable number for IWM's trade on Thursday last week, call open interest is only up about 6%, maybe to 10% over the lows. And so as you can see here, this is a one-year chart. Call open interest has not hit this extreme where you can go, oh my gosh, like this is an NVIDIA level of overdone. So call volume clearly popping here, which is a signal of, I think, longer term strength. Short term, we're like a little bit overbought here is what this is telling me. But because this open interest seems like it has plenty of room to build, I think this theme of IWMs or the Russell small cap space maybe closing some of the underperformance is quite possible. One of the problems in that I'd flag here about buying IWM calls right now is this is 1 month skew, which is essentially showing you the implied volatility values of options that expire a month from now. You can see that to the right side of this chart, the term structure, or excuse me, the skew is very elevated, right? So this shaded cone shows us the 90-day range of implied volatility for 1 month options. And we are way above, for upside call strikes, we are way above that 90-day range. Now, this is a function of the fact that IWM rallied 5+% over the last 2 days, but also that call demand, right? And what this basically tells me is that if you're buying a IWM call, you're buying it after the trade has already started to take place, right? And so you are paying up a lot for those calls. And that generally to me says that we're short-term overbought, right? We need a little bit of a pullback. We need a little bit of consolidation. That syncs up really well with options expiration this week. So we get some consolidation, and that's a nice kind of like a trampoline or like a slingshot. You got to pull it back and let it go, right? And this pullback period is maybe coming up, I think, here over the next couple of days.
Yeah, it was crazy. I think last Thursday, I think it was Bespoke that had this data. Like last Thursday was the second day ever that the Russell was up 3% and the S&P was down. So it's just crazy, like the degree to which that happened.
Yeah, it's there's so many crazy things like that going on, and it's a great segue into some of the things that we're seeing here in the equity volatility landscape. So beautiful transition, Jack. Kudos to you on that, because these relationships are all super bizarre. Realize while we already touched on that. Before we talk about correlation, I wanted to frame just how unusual the S&P volatility is, right? So the reason that this ties into correlation is because you've likely heard about the correlation trade. There was like an Odd Lots podcast about it recently. It's all over the place, right? And essentially what the correlation means is that the individual components of the S&P 500 specifically are moving a lot more and in different directions than the index itself. So what you end up having, obviously, is Apple, NVIDIA, et cetera, ripping, and the index itself is being pretty sleepy and just kind of grinding higher. This chart we debuted in our April OPEX series, and I've seen it all over the place. So I think we started a trend of looking at the market like this, but this is the number of days in the S&P without a 2% one-day loss. In the great financial crisis, that's 2007, we hit the most number of days ever at over 900. Going into Volmageddon, we had over 350 days right in that area without a one-day loss, and now we are right on that same number. So it's an extreme number of days without a 2% one-day loss. I think this is a function, and if you go to YouTube and you look up volatility suppression spot gamma, you can look at our video about this. But basically, it's a function of zero DTE trading, systematic call overriding, which builds up this positive gamma. Remember at the start, we talked about positive gamma and how that suppresses market volatility. And then the third aspect is this correlation trade. Specifically, what happens in the correlation trade in the options land is people sell S&P 500 index vol and they buy single stock vol. So, I'm buying NVIDIA options, or I'm going to buy NVIDIA calls. I'm going to sell S&P calls is a very crude way of looking at it. Now,
So
yeah, please.
I'm just thinking it's interesting, like, because it must be tough to judge these things, because I was just thinking, like, every time you have one of these, you've got like this different fact pattern. So like in Volmageddon, we had the short, volatility ETFs. Now we've got these zero DTE options, which weren't really a big thing. So it's like every time it's like, yeah, this can't go on any longer, but you also have to look at what are the circumstances that are causing it. And they always seem to be different.
Without a doubt. And, are we at the great financial crisis? I don't think so. I'm unqualified to make that comment. Are we at Volmageddon? That seems more likely to me. And I say that because it's positional risks, right? Where somebody's offsides on the short vol product. Here, I think people are offsides in their concentration of the top stocks in the indexes, as opposed to there being unlimited credit risk due to subprime mortgages or whatever else it may be, right? But your point is spot on, right? What is the cause? And the thing that when the Wall Street Journal posts this, or Schwab posts this chart, or whoever does, they don't ever talk about the other side of it. The other side is we're going extreme amounts of days without a 2% gain. So interestingly, the largest ever time without a 2% one-day gain is the Great Financial Crisis, because volatility just gets suppressed during those time periods. You can see going into vol again, we also had the second largest, at least since the 2000s, second largest period of days without a 2% rally. If you added, we had one day this year where we had a 2% rally. You probably remember what day this was. Do you remember, Jack?
Was it NVIDIA earnings?
NVIDIA earnings. Very good. I knew you knew that answer. In February, NVIDIA blew out earnings, and that lifted the S&P 500 by 2%. That was in February. We haven't had another 2% rally since. And so I don't want to say, hey, if you take that one day out, we have a record. But if you take that one day out and you add the pre-NVIDIA earnings to what's happened since, well, we're at Volmageddon numbers, right? In terms of calm. So this is all very unprecedented. And so when you look at this stuff and people say, yes, the market should continue to rally, and yes, this should happen. How many never seen before things end with the market just sort of saying like, okay, that was a weird period, let's continue forward without some sort of reconciliation, right? I think, I don't know, stat check that. I just feel like in my 20 plus years of experience, when you see all these, hey, never seen before things, it generally expresses in some sort of like spasm again, where we sort of, all the relationships kind of fall back in order, right?
Yeah, what was interesting to me on this 2% gain thing, by the way, is the beginning of like the tech boom.
Yeah.
I wouldn't have thought that would have been on there. And I guess it was early before like the big returns started coming. But yeah, I mean, we had a huge run before the tech boom where there wasn't a 2% one-day gain, which surprised me.
Yeah, and no, I don't know what the economic, intricacies of the economic policies and things like that were, but what caught me about the Great Financial Crisis is that there was all this liquidity flooding the system, right? And that created the conditions for the Great Financial Crisis. And so I think when you look at globally in our last OPEX video, we're talking about how the short volatility trade or a lack of volatility was a kind of a global phenomenon, right? We didn't have a lot of volatility in Europe in equities. We didn't have a lot of volatility in global credit and blah, blah, blah. And now we're starting to see that all get shaken up a little bit, where you had like the strange election in France, right? Where vol started to react to that. We're having some spasms a little bit now. Like there's the underpinnings of things shaking up a little bit. And I don't know if this is just a tremor and will continue, or something that is positioning a little bit bigger. But again, I don't think this is the Great Financial Crisis, more just sort of a positional imbalance that has to get, I guess, reset. The 2% one-day gain stuff is interesting about the internet bubble. As you can see, there's a small number of days without a 2% rally, but you did have unbelievable dispersion in that time frame because those internet stocks were going so crazy. So we had record high dispersion during that time frame. We have very, very high dispersion, as we're going to show here in a chart in a few minutes, because of these chip stocks, but we're not at 2000 bubble levels yet. Implied correlation, which is measured by the SIBO here. This looks at options that are 1 month, expire 1 month. That's what you see in blue. Options that expire in 3 months is in gold. And what that looks at is implied volatility of the index, the S&P itself, versus the top 50 constituents. So the lower this goes tells you that the higher the constituents vol is versus the index vol. We broke 2017 now this past week. As you can see here, we've been below the 2017 low in 3-month correlation. So we have record low correlation. We've never seen a situation like this before where the index vol is so low compared to the single stock vol. Again, very strange, right? And this turns to this interesting idea of correlation. So a lot of what we covered before in the April videos and kind of sense was intercorrelation, meaning how uncorrelated are the components of the S&P 500 to the index itself. So like NVIDIA is moving so much and the S&P isn't moving a lot. This is kind of what I'm framing as intra-correlation, where on this chart here I have NVIDIA, which is obviously the king, versus IWM, SMH, spiders, and the diamonds. And you can see heading into last week, what was so uncorrelated, and in this quick plot since 2000, this correlation of the Dow is bizarre, right? And if you look at the components of the Dow, it's like Nike, Boeing, I think was Walgreens in there. I mean, the list of stocks in there are stomping grounds for, just the garbage stopping grounds right now. It doesn't have NVIDIA, it doesn't have as Apple, but it's missing, it's not tech heavy and it's getting left behind. And then the components does has McDonald's and stuff, they're just not doing very well. And so it has actually become inversely correlated to like the Qs or NVIDIA or and some of these other indices, which is fascinating to me because it's rarefied air, right? Also, after OPEX, NVIDIA correlation is now snapped back in line. That's what this blue line is, snapped back in line with the Qs themselves, right? So we talked about how uncorrelated it was into June OPEX. We removed all those big call positions, and now NVIDIA is kind of falling more in line with the broader indices, which I think is really fascinating. I also want to point to you here to IWM, which is on gold, is in gold here, the color. It still has a positive correlation with the Qs and the spiders, but as you can see here, it's fairly uncorrelated. And you know, you would understand this relationship a little bit better than me, but you know, it's not unusual for the small caps to be so uncorrelated. But this is the view heading into last week when I made this presentation. So if I forward one slide and you account for the last 2-3 days, what you see is now IWM is now inversely correlated to the rest of the market slightly, specifically the spiders is what I'm showing here. And so now the Qs are spasming, the IWMs are having these bizarre spasms. I've also added the TLT here, which became positively correlated with equities, which is the long-term bonds. And now that's having some spasms because rates may come down or we may get a rate cut due to the CPI and some of the recent inflationary data. So things here are under the surface flopping all over the place, and we're in this period where traditional relationships, long-standing relationships, i.e. all equities go up at the same time, generally speaking, or all indices go up at the same time at least, that's not holding true anymore.
Just one aside as we go here. Like I just learned, I was like today years old when I realized that when you guys talk about dispersion, options guys, you're talking about what's implied like 30 days out in the market. You're not talking about what happened in the past.
Exactly.
Because I said that wrong in a different podcast, and someone corrected me and put the quote on there on Twitter to challenge me on that I had that wrong.
Yeah. So and to be clear about that, when I was talking about these correlation indices, they're based on 1 month options, right? Those options expire in the future. So this is forward-looking correlation, which is why when we're talking in June about our forecast for saying, I think vol is going to come down, well, the options market's pricing in lower correlation in 1 month and 3 month forward periods. And so that is generally associated with volatility going lower. And that is what played out. And that's what the value is here. I have a couple of charts we're going to show, which the S&P global data analyst posted, which is actually sort of realized dispersion, I guess you want to call it that, or realized correlation, how the markets have been behaving. And this chart here is realized correlation. How have these relationships been behaving? This is on the right here is the historical correlation matrix from early last week. And you can see that typically, again, you know, like the Dow has a 86 correlation with the IWMs, right? Okay, Dow goes up, IWM typically goes up, the Qs typically go up. They're generally all pretty related, right? You can see here there's this negative correlation over the last month with NVIDIA in the Dow or SMH in the Dow, right? There's the relationships when you see these blue squares means that things are not acting normally at all. Well, this is that same grid matrix just updated for today. And suddenly what you get, and this is versus the spiders, which is why some of the colors are a little bit different. But you can see here now the IWMs over the last month are like in a different universe, right? Things are just really wonky and really shifting all over. And the reason I showed this SPY versus TLT is because after that CPI print, you also, you know, see that historically we get an inverse correlation between TLT, which is the long bond ETF, and the equity indices. But now that correlation is mildly positive. So again, there's just all sorts of stuff shifting around here that is really rather unusual.
What do you like? How do you think about this stuff when you see these weird things going on? Like I'm wondering like how your average investor should think about it. Like, does it imply like high levels of risk because of all this weirdness is going on? Like, how would we think about it?
I believe that this is high levels of short-term risk. So if you were to draw, let's say, a 200-day moving average of the stock market, right? That 200-day moving average goes up, from the bottom left on a chart to the top right, and that's what the trend is. However, if you were going to plot like a 9-day moving average, you would see that the 9-day moving average is now, 2 standard deviations, let's say, above the 200-day moving average. We're overbought from that condition, right? There's all these bizarre relationships that has forced short-term markets way above its 200-day moving average. And so we're due to correct, I believe. And when all of this stuff sinks back up, it leads to a market crash, but that takes us back down to the 200-day moving average, and then we continue higher. So, I know that's a little bit of a bizarre analogy. Hopefully you can understand that. The trend is still intact. It's just we're so overbought from the trend line that, we're due for a correction.
And when someone like me sees something like, the Russell's up 3% in one day and the S&P's down, like someone who doesn't understand it that well, like me, how much of that was the options market that was driving that?
When you have record call positions driving into the markets now, you are getting a tremendous amount of short-term speculative behavior. And when you get record calls being bought or record call positions coming in, that puts a massive impetus on dealers and market makers to have to chase the stock. And options, in my view, are from that perspective, they're leverage, right? If you buy one call option, that is a potentially up to 100 shares of IWM at, tens of thousands of dollars of value that has to be purchased in order to, potentially hedge out your one lot call option. And so that adds to the volatility. That adds to the volatility to the upside, but when those calls are closed or shift around, then that volatility also rears its head to the downside as well. And no other, what other evidence than you need than what we saw into options expiration in NVIDIA, where you could see this call imbalance and you go, hey, like we've never seen something like this before. We've never seen the call options complex so big in NVIDIA ever. And then bam, right at options expiration, the stock loses, 20, 30% in a heartbeat, right? But to the point on trend is we were super extended over the long-term trend, and then simply we just came back to earth, and now it's kind of back to its trend. So you're getting, again, these short-term spasms, like the patient doesn't die, it just sort of like shakes around a little bit and then dusts itself off, right? As a kind of a crude analogy.
So the answer is probably a lot, right? Like in terms of what happened that day, option dealer flows probably played a pretty big role in what was going on.
I 100%. That's what our business is based on. We watch this stuff all day long. The interesting thing now is you have so much short-dated options activity, right? That these flows come in today, or they're impactful in a certain direction or a certain way today, and then tomorrow it could be totally different, right? Now, what we see every day now is 0DT tends to buy the dip and sell the rip in the S&P 500. You get a lot of speculative call buying in whatever the hottest name is of the moment, but that flow is short-lived, obviously, because it's here today, gone tomorrow. It doesn't translate into material positions oftentimes. If you get a lot of longer-dated call buying in different names, like I love to see that, because when you have longer-term positions, that implies that there's longer-term hedges in place. So I'd love to see, call options, 1 month, 2 months, 3 months out in time for IWMs. I'd love to see those build up, because I know if the stock starts to rally, dealers have to continue hedging in that direction as the stock goes up. A lot of times, if you think about like a meme mania, right, where people are buying into the news of something, that's kind of what 0DT options volume is. It's like you have a stock go crazy, it goes up 20, 30% in a day. And if you see something go up 20, 30% in a day, you go, that's not sustainable, right? It's probably going to crash tomorrow. And that's the kind of thing that you see when you get a lot of short-term options behavior too, right? Oh, it's all the 0DTE people buying today. That rally could fade tomorrow, in a heartbeat.
Yeah, and it's interesting because like fundamental guys like me, we always have a fundamental narrative for days like that. So, the idea is like if inflation is coming down and rates are coming down, small caps are more sensitive to rates, so small caps should rally a lot. And sometimes that's true, but also sometimes on those days, you just got these options dynamics going on, and then the thing just reverses. So it's interesting. We try to explain like these one-day moves, but sometimes it's something else besides what we think it is.
Yeah, and so to your point, what should the IWM have moved up, over the last 2 days? Is it 2%, 3%? I don't know. But if you're going to tell me that there's record call volume of 3.9 million contracts, I could tell you that whatever the positive move was, it was exacerbated by the options market. I don't know exactly how to extrapolate, that's impact specifically, but you can line up the correlation of largest moves ever with the biggest options positions, right? So you see those relationships over time. And if you know that the options market is heavily involved with these positions, then you can say, okay, great, maybe I should sell some short-term calls, or maybe I should wait for a little bit of a pullback. Then I can, reallocate, right? I can add more to my long-term allocation. If you're buying into the day where you had 4 or 5 million call contracts traded at IWM, you're buying when volatility is very high. You're buying, kind of into the hottest point of the move, in my view. And generally saying, okay, let's wait for the options market to cool off a little bit, tell us that things are a little more sensible, I could probably get a better price, and then, we base and sort of head higher, which is what I'm sort of looking for in the IWMs now.
So on this next slide, you're looking at realized correlation between the S&P 500 and a mid-cap and a small-cap index.
Yeah, and you had mentioned this before about realized correlation. You can see just here the quick takeaway is correlation is very low. Realized, we'll call it realized dispersion, which is that blue line, is very, very high. If you go back to 2000s, this is the same general area in the large cap, that's the S&P 500. But the dispersion is very high in the small cap and the mid caps as well. And this dispersion just says the individual components of the index are moving a lot more relative to the index itself. This can happen when the market crashes, right? Because all stocks go down, but we talked about this in the March of 2020 crash. All stocks went down, but like cruise lines went to zero, right? Whereas like hospital stocks maybe held up a little better, for example. So, dispersion with correlation going up is what you see during a crash. Now we have correlation going down, but dispersion increasing. That's a bubble sign, right? And that's what we're sort of watching for now. This map is from S&P Global. I couldn't find it updated. So this particular map ends in 2015. But what was so interesting to me about it was those bubble periods of 2000 and 2001. And so what you see here is dispersion was a lot higher in 2000s because like pets.com was just going at next level crazy. Dispersion was also higher in the 2008, 2009 crisis. But we're higher than we had dispersion-wise in 2007 during the run-up to the Great Financial Crisis. But correlation now is lower, arguably, than it's been in terms of realized correlation. We're lower now than we were during the internet bubble. So this just puts us into place in terms of where we were during historic major moves in the market. So, not quite the internet bubble, but correlation-wise, we're in kind of rarefied air.
Can you just, for people who don't know, can you just explain the difference between dispersion and correlation?
Yeah. So correlation measures how each individual component of an index moves relative to itself. So if we have all stocks crashing, that gives correlation of 1 because every single stock is going down. In this situation, relative to breadth and things like that, you've seen all these charts, I'm sure, where, it's, hey, this is the first time that 80% of the S&P 500 components have gone down, but the index itself still gained in price, right? That is low correlation, right? Because NVIDIA, Apple, they're going up, but Nike and Boeing are going down, right? The components aren't moving in sync with each other. What dispersion measures is how far apart the performance is of the individual components. So higher dispersion comes when NVIDIA goes up 50%, Apple goes up 20%, and then you have Boeing going, down 5% or whatever it may be, right? The components of the individual indexes their performance is spreading out. If you have low correlation like we have now, but really high dispersion, that's signals of a bubble period because you have certain sectors that are going crazy, right? AI and chip stocks are going bananas and mega caps are doing really well, but there's a lot of more traditional, maybe value-oriented names or whatever it may be that are being left in the dirt, right? Left in the dust. And so you're getting high dispersion, right? Because of just certain names are just going crazy while other names aren't doing much at all. So if we just had all stocks go up every day and every stock goes up 1% in unison, then you would have a low dispersion, high correlation market. Obviously not what we have right now.
No, yeah, we have the exact opposite. And you kind of get at that in this next slide here. You're talking about the deviation in returns depending on the index you're looking at.
Yeah, and this is a chart that I probably should have updated for today because of the fact that IWMs have rallied 5%. So the IWMs now year to date are going to be above the Dow, I believe, because of the 5% gain suddenly. Still way behind the Qs and the spiders. And the point is that what stock you buy in this environment matters so much, right? Because it's not a all stocks up phenomenon. Qs do great, spiders doing great. Dow, you're only up 4% this year. As of Thursday or Wednesday or Thursday of last week, and IWMs now, because they gained 5%, they were only up 1% into middle of last week, right? And so, this speaks to this uncorrelated dispersion trade in a way, right? Because tech is doing great, but everything else is doing actually pretty bad. And I think about this because imagine being a manager that is more in the small cap space or underallocated to NVIDIA and hey, I got 6 months left in the year. How do I make up this, my equity underperformance? It's probably, an issue for a lot of managers at this point.
This next one is really interesting. This bad breath in terms of how much the big stocks are driving the market. Like I think I saw somewhere that I think NVIDIA itself might be like more than 4% of the move this year in the S&P. That may be wrong, but it's a huge number.
It's incredible. And so what this chart shows us is the top 10 as a percent of the S&P 500. We're currently at 77.2%. This comes from Strategis ETF Research as of 7/1. So this chart's about 2 weeks old now, so it's changed maybe a little bit, probably not that much. That 77% is higher than any other period except for, drumroll, 2007, which was 78% of the index. Now, these top 10, according to Strategis, says that accounts for 14.5% of the S&P 500 performance, which interestingly is not, those top stocks, they've been a larger percentage of performance, interestingly, if you look at that historically. So in 2000,
though,
yeah.
Is that just, so what's the S&P return this year as of right now? Do you know? It's like almost
that is the S&P 500 return. It's 14.5%. Well,
okay. That's the return.
That's as of early July. So we've gained another 2-3%.
How much they've contributed to the return? That's just the return.
Correct. That's just the return. Yes, sir.
Okay.
So the point is that I guess 2007 was not a very good period for the market because it was 3.5%, but 14.5% return is lower than we've seen for the next 10, 15 time frames on that chart. I just want to bring up 2017 because the top 10% as a total in 2017, which was this other year that pops up, was only 30%. So it's much more balanced. So this speaks to the breadth, right? There's 3 stocks which are 20% roughly of the index, which I have this chart here, which shows you the impact of that. I'll get into that in a second, but basically, you have NVIDIA, Apple, Microsoft, which is I think 20% of the S&P, and it's 25% of the Nasdaq. It's really pretty wild, right?
And I wonder, this may be a question that we don't have the answer to, but like these periods where the largest stocks are driving the market, do those also tend to be periods where there's low volatility? I wonder, is there any relationship there at all?
I mean, when you look at this chart, you could make that. I suppose you could make that claim, right? In 2024, obviously we're at that level. In 2023, we're kind of coming off of a bottom a little bit, and really rallied. So I don't think volatility is particularly low that year. It's hard, to your point. I've not studied this. There's not a clear correlation other than to say, well, 2017 pops up here. 2007 was a very calm year. That pops up here. But I have not. It's an interesting idea. I have not looked at that myself. I wanted to show this. This is the next expiration stats for NVIDIA, Apple, Microsoft, and Tesla. Tesla's one of the top names in terms of options volumes. Had great performance. And what I wanted to show here was this is the percentage of volume that expires on the next Friday. And I'm going somewhere with this, right? Related to correlation. 50+%, sometimes as high as 60% of options volume for these names is I call it 0 DTE. That means it's just trading at the next expiration. But you're talking only about 8% of open interest sits at that next expiration time frame, right? And that seems to be declining, as you can see on this chart. So the point is that there is a tremendous amount of day trading in NVIDIA, Apple, Microsoft, and Tesla in these top stocks. And so I think that there's a lot of trades now that are day trades, let's call them high frequency trading, et cetera, that use the options of NVIDIA, Apple, Microsoft, et cetera, to trade maybe against the S&P or in and amongst themselves. And I think that these have material impact on the performance of these stocks. And so if you see head scratching, bizarre moves in these names, you have to look at the options complex to see, was there just a ton of 0 DTE stock trading on this thing that's causing weird pockets of volatility or whatever it may be? To your point before, you have a lot of longer term investors that, are trying to figure out, well, why did NVIDIA just do that today? Or why did Microsoft just do that today? And if you had several million NVIDIA 0 DTE calls trade in and out today, well, that could cause a lot of bizarre impact. Is the
use of 0 DTE still rising a lot, or is it calmed down?
It's really flattened out. Similarly, if you look at the S&P chart, it looks like this, where about 50% of S&P, 55% of S&P options are 0 DTE. It doesn't have particularly large open interest, and we're not increasing really all that much. The trend is really plateaued across the board. Now you can have rolling names which suddenly spike up, like IWM suddenly has massive next expiration or 0 DTE call volumes because of what happened last week, and now that's sort of subsiding a little bit. But this 60% threshold, we really don't see much higher levels in the S&P or single stocks over that. So again, it's the day trading that's having an impact. I wanted to look at this. This was from Wednesday, right? Wednesday, we had a very sneaky, bizarre move up in the S&P 500. And the following day, we had a big move down. And there was an interesting note from a Bloomberg reporter saying, I can't figure out, one good reason why the S&P was down so much today. And she was talking about Thursday. Well, I present to you this idea of breadth in the options market. So you have 50 to 60% of volume is next expiration flow. What did that mean? This is on Wednesday. What were the impacts of these specific names to the performance of the S&P? This is just for Wednesday when the S&P was up about 1%. Well, 19 or 20 bips of the performance from that day was just from NVIDIA. Add another 13 bips from Apple and 11 bips from Microsoft. You end up with 40 to 50 bips of S&P 500 impact just from those three names, right? Those three names going up 4 or 5%, what they did, pushes the S&P up 50 bips. The next largest component is Google, Amazon, etc. Those are adding 2-3 bips. It's mostly meaningless. Now, on the flip side of that, there's these names that are falling off a cliff, like MasterCard or Costco had a really bad day last week. They're so small as a component of the S&P 500 that they can crash 5, 6, 7, 10%, and they do nothing to the impact of the S&P. So this correlation, when everyone talks about bad breadth, and it's a sign of just investors in too narrow of an impact from a more of a psychological perspective almost, there's a positional or a hedging impact or a trading impact of the fact that these components are so large. When you have zero DTE or next expiration options dominating these names a lot of times, that tells you that the index itself is being dominated in turn because of the fact that 20 to 25% of the index component itself are driven by just these three names. And so you have record calls pile into NVIDIA, next expiration, these people are day trading. That jacks up NVIDIA, which jacks up the S&P 500. And the next day, those people don't care. They're only there for the day. They're not looking forward a month or 2 months or 3 months. They don't care. So the next day they sell those calls or whatever they do, right? Thursday was some of the biggest call selling we've seen in a really long time in these top three names. And these stocks all crash and down goes the S&P. So this is the correlation spasm, right? This is the essence of it. This is shown for just a single day, again, Wednesday, but you can play this out on a daily basis, right? So when we're looking at all-time low correlation or volatility being at record lows on the index, you have these big three components. They're whipping around can really dictate a lot of what happens on a short-term basis on the index itself.
Yeah, what was interesting is I saw this thing on that day where we had the Russell up 3% and the S&P down 80 basis points. Like the losses, the dollar losses, like on the Mag 7 stocks were so much greater than the gains on the entire Russell 2000, the dollar gains. Like these companies are just so massive. Like we don't even is Apple bigger than the entire Russell 2000? I'm not sure if it is. I thought at one point it was.
I believe it still is. Yeah. I mean, after I don't know about it recently,
it's pretty amazing just thinking about just these individual companies mean more than the entire Russell 2000.
And not only that, these each are about $3 trillion, right? NVIDIA, I think it's still over that threshold. They move 4 or 5% a day. It's incredible, the volatility in those components. And I posted a chart on Twitter/X before, just thinking about this. NVIDIA is 25% of the NASDAQ. It's 7% of the S&P 500. It's not 20% of the Qs. I forget the constituent. It's very high, right? It's 20% of the SMH, 25% of the XLK, right? And so there are all these index funds that have to own a ton of NVIDIA just as a function of them having to track these major ETFs, right? And our major indices. Then you have NVIDIA triple levered ETFs, which is, I think, $3, $4, $5 billion now in size. So there are all these index demands for the individual stock itself. Then you have, very large hedge fund holdings, right? And the point that I'm trying to get at is there's so much of the free float or the tradable float that's just off of the books because of the fact that these indexers have to hold the stock, right? And they have the stock locked up. So what is the tradable float of NVIDIA? Is it like half or a third of the free float? And then you have record options trading, and the reason the record options matters is because there's hedging flows. which have to be tied to the underlying stock itself in a lot of cases. So what is the actual liquidity of NVIDIA or Apple or Microsoft? I bet you the liquidity is just pretty poor. And so that's why you're getting these giant moves, right? 5% up and 5% down, just because there's just not enough stock to trade, if that line of thinking makes sense.
So on this next chart, I think you have something similar, but you have it in chart form.
Yeah, we're just also talking about the bad breath and the fact that when you see, NVIDIA and Apple and these stocks really move up and down, you start to get the tail wagging the dog a little bit. And what's so interesting about this is that we had 10 days, I believe it was, is what the meat of this chart is showing, where the VIX was up as the stock market was going up, right? That was leading into early last week. And so this is a stock up, vol up environment because the components of the index are moving up so much themselves. And obviously, as I just, outlined my theory as to why this matters. If you have a situation now where NVIDIA, Apple, Microsoft sell off some, right? They have a good sell-off. Vol in the S&P 500 is not going to go down because of that, right? Vol is likely to even increase. You can't have, in my view, stock up, vol up, which simply means these names are moving up so much that the volatility metrics are also moving up for these names. When these stocks revert and go down, we're likely to see index vol spike up as well. So when I talk about these spasms, when these names are so overbought and overextended, or if you have a rotation out of these names into small caps or breadth widen out, when these names get rotated out of, they're going to have a volatility sort of spasm to the downside, in my view, because of the fact that they've had volatility spasms to the upside, right? In other words, you can't just have these names plain out. You have to have sort of a kind of a large move down or a little bit of a spasm down in order for breadth to widen out. Well, because they're such a large component of the S&P 500, if those three stocks go down, the S&P is going to get pulled down as well. So you had this situation before where you mentioned this was like the biggest move up in the IWM for a negative move in the Qs, right? One of the larger ones on record. That's a function of what happens here. If you're going to rotate out of the S&P and go into small caps, you're going to get these big three names going down, which is going to weigh down the Qs a whole lot. It's going to weigh down the S&P a whole lot, which means that the rotation out of the Qs and spiders is going to be more violent, right? And then the rotation into the IWMs is also going to be a little bit more violent. You can't have just this smooth sort of sector rotation out of equities. And further, I'd note, if it was a rotation out of equities, you'd see all equities down instead of what clearly looked like a rotation out of, tech large cap into small cap. So, all right, let's get to the punchline here. We talked about vol being low and correlation being low. We're seeing a lot of record-looking put-call ratios, which is generally an overbought signal as well. We're obviously seeing that what we talked about in the IWM. Record calls or record puts trading is often an indication of interim highs and lows. So that's why we're watching the put-call ratio here, which is obviously higher than we saw back in 2021. The key here is that the breadth of what's receiving record call positions is pretty narrow. In 2021, everything was getting a ton of call positions. Now we're seeing smaller tack vectors, so to speak. NVIDIA will get a bunch of calls. IWM will get a bunch of calls, but you don't see big call positions in a lot of the other 490, S&P 500 names. Last chart I'll talk about in this before I move forward this is from the SIBO. This shows us that single stock vol is at a record versus index vol. So we're talking about the impacts of correlation, all this stuff. This is simply saying that the volatility levels, the implied volatility levels of the components are higher than ever against the index itself. It's very unusual. This would rectify with single stock in index vol spiking at the same time, to my last point. That's why I think we could get a spasm where we just sort of get a decent drawdown, 3, 4, 5% as a lot of these relationships reset. Last thing, just to note, short interest, I thought this was interesting, is that as record lows per, I believe this is JP Morgan, just another one of these charts that is extremely bizarre, right? And if there's just a little bit of shorting in the market, what happens to that in some of the face of some of this liquidity? So July OPEX, what to watch. I know we're getting long in this video, so I'll be quick. Here we see just this pile into, this is the Russell futures versus the NASDAQ futures. I'm looking for, somewhere around a 3% pullback to the stats we initially talked about here in the Qs, similar pullback in the Russell. And then that's kind of a launch pad for new highs, I think, moving forward. And I do think that we're going to see the small caps in breadth widen out. However, because the concentration is so high in these certain stocks, I think that the Qs and the spiders are going to underperform and risk a larger pullback here in the short term as a lot of these relationships sort of shift back to normal, right? These relationships normalizing, I think, have to normalize with the bigger pullback in the Qs and the spiders, whereas the IWMs may be able to kind of catch a stronger bounce. Single stock side, I want to talk about Tesla. Tesla's up just a tremendous amount, 40-something% over the last couple of weeks. The positions, we're going to lose about a third to a half of positions this expiration in Tesla. As you can see via my red arrow, most of those positions are concentrated right around this 250, 260 area. That stabilized Tesla in this price range. We're going to lose some of that. The Tesla robotaxi situation got punted to October. Earnings are coming up next week. I think this is a time frame where Tesla's going to retrace a little bit, rebase, looking for that 225 area as short-term support for Tesla. So I just wanted to give a future look for a specific stock that has a ton of options positions here. Again, this will be an OPEX-driven pullback of about, I would say, 10% is what I'm looking for in Tesla. And vols here in Tesla, as that robotaxi news came, you can see vol from last Monday was here at the gray line. That vol's now come down after that robotaxi news is pushed off. So this tells us that call demand is cooling. That generally syncs with a stock that is going to come down as well.
So in this next one, you're talking about some potential paths here.
Yeah, and this zooms out to the idea of correlation and how we normalize in a lot of these relationships that are weird. Number one is breadth widens out, and that's broadly seen as supportive of stronger equities. Maybe Trump being the favored in the election and CPI coming down and soft landing, maybe that all comes into purview. People rotate into the names, which is just underperformed so much, and that would be a great bullish signal. I don't think that we can normalize and have NVIDIA and Apple and Microsoft not correct relative to these other stocks. But that breadth widening out would be, I think, what bulls really want to see, and there's some evidence that could happen now. So we have to respect that. If we get an OPEX pullback, that would be a good time to maybe look at buying some of these names that could benefit, right? That have not performed so well. Second, the other way that this would work is that if you get a rate jump, which doesn't seem to be on the table right now, some type of credit event, which doesn't seem to be on the table right now because of obviously people are now pricing cuts. Geopolitical seems to be fading a little bit. At least it's not hot like it was recently. Or if we have an issue where NVIDIA earnings aren't that great, or some of the AI names don't seem like they're going to, have great names, that we lose that narrative or that dogma, that then drains off the components, right, that are leading the market. So if any of those happen, you could see the market violently spasm, where correlation really shifts up and vol jumps a lot as a result. This is kind of, we saw a preview of this in April, right? S&P dropped 5% over that same time frame. NVIDIA dropped 20% over the course of about a week. VIX moved up to 20, correlation jump. Now that was sort of the kind of thing that we are, that's kind of like a baby spasm, right, that we'd be looking for. Those concerns all were assuaged, and then we started to rally again. But that was sort of a little appetizer idea of the type of move that I would expect to see. Now, if a real credit event does happen, or some other event does happen, then that 5% move in the S&P is going to be, more like 10% in the S&P. But at the moment, this does not seem to be on the table with the developments over the past week.
So in this section, you're getting into more detail on the correlation unwind.
Yeah, exactly. And I just wanted to, again, frame how bizarre some of these moves are. We talked about correlation a lot. In April, here's the resyncing where correlation just jumped so high, and you can see that synchronizes with vol jumping quite a bit. So the point here for most of you with longer term lenses is, if you see a big move down and you're scratching your head saying, not scratching yourself, but scratching your head, thinking, why is this move so big? I don't get it, right? If those words are coming out, this doesn't make sense. You need to look to this relationship, this positional relationship, and the options impact of the market movement, a la last week with IWMs and some of the weird behaviors, as an exacerbator or bringing leverage into whatever move we're experiencing, right? So if you find yourself going like, I don't get this move, it doesn't make sense, look at the options market and realize that those moves that you're seeing could be magnified quite a bit by what we're seeing or these bizarre relationships. And to this point here, this just shows you that when you had stock up, vol up, and NVIDIA, when the stock crashes, vol remains high, right? Which is not to say that, which is just simply to say that if these big three correct, that likely invokes or brings up, let's say, the VIX as a measure of index volatility. This inflation inbound, people were talking about Trump possibly being inflationary. I thought this was an interesting chart because the point here being that we're coming up into a election cycle now where people are unsure of the election risks. I think maybe there's not so many risks, but what are the policy impacts of the various, possible presidents and what they may do? Inflation is a concern when you go forward. And all I'm trying to bring up here is the yield curve seemed to shift a lot when Trump was favored out of the debate. This is what this chart is based around. I don't know if people are going to continue forecasting that. I think Morgan or somebody, Bank of America, put out a note today saying, no, Trump won't be inflationary. I don't really know. All I'm trying to say is that there's the potential for a lot of relationships shifting again as we move to the election period. And when these relationships shift, it could really have an impact on these correlation positions that we've been talking about a lot. This chart obviously needs to be removed as of this morning because I think Trump has jumped so much. This chart shows the Biden-Harris, odds. Who knows what's going on with all this after the events of
yeah.
Saturday.
What's interesting though is it probably means what happened probably means Biden stays in. So I would guess if you updated this, Harris has probably fallen a lot. Because nobody's going to want to run against Trump right now. So the odds are they probably, the stuff about Biden dropping out probably goes away.
Yeah,
my guess.
That's extremely insightful, and that's a second order thought that I wouldn't have come up on even if I had an opportunity this morning. So kudos to you. And it's just so funny. I was like scrambling, thinking all of these charts changed so much just because of just what happened on Saturday. It's really pretty remarkable. This is here is the point on France volatility. This is the CAC 1 month implied vol. Just the point that, we've gone from record calm globally, and now you have elections shifting expectations, shifting vol. You have a lot of big banks in France, obviously, and if they have problems, just as an example, well, that's the butterfly effect here in the U.S., right? So we're all linked here, and when you start to get, spasms of things around the world, that can affect particularly U.S. volatility markets. So just another example, something that could have popped up. Not sure what the situation there is in France, but things are obviously really quite dynamic. Last but not least this is the fragility index. This talks about the liquidity of markets. B of A basically does this test where they look at realized vol. I forget the exact metric here. But essentially what they call is the fragility index. And it's essentially how much can big components move the stock price. And we're at what they call record fragility. And again, all this simply says is you have situations where like Salesforce can drop 5 to 10%. Delta Airlines was down 10% last week. You have Costco drop 8%. Those moves are bizarre. They are very unusual. And I think it speaks to this idea of a lack of liquidity, generally speaking, in the market. And whether that's because of these index sort of effects or whatever else it may be, things are moving based on this data. It is unusual how much stocks are moving. There's not a lot of liquidity in these names. Now, they seem to bounce okay afterwards, but when you have all these bizarre relationships and then you have these options flows, which can, in my view, be like forced flows, right? Like I have to hedge my call position. It's like a margin call. I'm going to buy stock here and it's going to drive the stock up. I don't have I can't sit around and wait to average in like a value investor might. So this fragility is just something to also consider when we're talking about the normalization of stock movements.
Well, this has been really great because for me, one of the things I think is really cool about this is even if you're a long-term investor like I am, we're seeing all these crazy things happening on a day-to-day basis. And even if you don't do anything with it, the ability to understand it, I think is so important. And like, that's what I really liked about this. And it's what I like about doing this podcast is because now I understand, like sometimes you'll overreact to things if you don't understand what they are. Like if you think there's some fundamental driver of something going on in the market and the reality is it's just going on something that's going on in the options market, you might make the wrong decision based on that. So yeah, I think it's really cool. It's been cool for me. And I think it's cool for long-term investors to understand this under the hood stuff so we can better, put it in the right context with our portfolios.
Yeah, that's exactly right. I think a lot of people say, hey, I don't trade options, so I don't want to look or care about this information. And, my soapbox is saying this stuff is driving a lot of the names that you trade every day. And while some of it may be a little more short term in terms of its impact, if you're looking to allocate into a name or take some off the table, if you know that, hey, this move is overdone because of an options, then selling into that or buying a dip around it or whatever it may be, I think could be extremely advantageous. like Delta Airlines last week, we were looking at it. There's no put positions below 42 in the stock. I haven't seen the stock this morning, but that was a great entry point, right? And why did the stock drop so 10%? Well, options positions are there. You have this fragility index, those kinds of things. So, it can really help put moves into context, to your point.
Yeah, thank you everybody for joining us, and we'll see you next month.
Thanks, Jack.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Lydia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Lydia Capital.